Hello, I am Edmond Jamna, and on behalf of DW Consult, I want to introduce to you Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, and shaky base in accounting to an expert position and to a place of confidence. It is also a platform to stay abreast in all matters of accounting. Tutorials on the Go is also designed to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as any tertiary accounting discipline. All that is required of you is to subscribe to our channel on YouTube at DW Consult and click on the notification bell to be part of it. Also, like and share the videos by way of inviting others to come aboard. Tutorials on the Go, bringing accounting to heart. Now, today's episode's lecture, Impairment of Assets, IAS 36. Now, the core principle of IAS 36 is that an asset must not be carried in the financial statement at more than its recoverable amount through either use or sale. So in accounting, impairment is a sudden or unexpected decline in the value of a company's non-current asset. Now, it can also be a drastic reduction in the recoverable amount of a non-current asset, both tangible and intangible. Okay. So impairment is different from depreciation in that whilst depreciation is an expected systematic reduction of an asset's value, typically due to wear and tear, impairment is usually a drastic or an unexpected drop in the fair value of an asset. So IAS 36 applies to all assets except inventories, assets arising from construction contracts, deferred tax assets, assets arising from employee benefits, financial assets, investment property carried at fair value, agricultural assets carried at fair value, insurance contracts, and non-current assets held for sale. So impairment normally occurs when the carrying value of an asset or a cash generating unit is higher than its recoverable amount. So let's go into the definition of the term one after the other. We'll first talk about a cash generating unit. Now, this is the smallest group of assets that independently generates cash flow and whose cash flow is largely independent of the cash flows generated by other assets. Now, this group of assets do not generate cash flows individually. For example, a train, a station, railway tracks, and perhaps a bridge are all required to produce passenger income. Another example can be a factory building, the factory equipment, the experts manning the equipment, the raw materials, that together can form a factory that will produce goods to be sold out to generate income. Now, this concept is used in the determination of asset impairment. Now, without the cash generating unit concept, it will be excessively difficult to determine the cash flows associated with individual assets for an impairment analysis. The second term you're going to define is the carrying amount. Now, also known as the net book value, it is the original cost of the asset less any accumulated depreciation and impairment losses. Now, this is also the value that is normally presented in the statement of financial position. Move on to talk about recoverable amounts. Now, it is the higher of an asset's fair value less cost of disposal and its value in use. Now, fair value is an asset's sales price agreed upon by a willing buyer and a seller, assuming both parties are knowledgeable and enter into the transaction without being induced. So in other words, it is the amount receivable or received from the sale of an asset. Now, fair value of an asset is different from its market value. The market value is the price of the asset on the market, normally influenced by demand and supply, whereas the fair value may include intrinsic qualities of the asset. So here the fair value goes beyond the parameters of what? The market value. Now let's talk about the cost of disposal. Now this is the incremental expense directly attributed to the disposal of an asset or a cash generating unit. It is sometimes known as the cost to sell. Value in use. This is the expected future cash flows, that is cash inflows and cash outflow, that the assets in its current condition will produce, discounted to the present value using appropriate discount rates. Now, sometimes the value in use of an individual asset cannot be determined, so the recoverable amount might be found for the cash generating unit. Now, an entity must perform tests for an impairment anytime within the accounting period when there is an evidence or an indicator. Okay. Now, when that happens, the recoverable amount of the asset must be calculated to determine if there is an impairment. At any point in time, the carrying value of the asset is unknown. So once that is known, to be able to know whether the asset has been impaired or not, you have to calculate the recoverable amount. Secondly, an entity at each reporting date is required to assess whether there is an indication of impairment. Okay. An intangible asset with indefinite useful life, not yet available for sale, and goodwill acquired in a business combination must be tested annually for impairment, irrespective of the presence of evidence. Lastly, the test for these 3 items mentioned above may be performed anytime within the year. However, the time that is picked for the testing must be done at the same time each year. Let's look at the types of evidences or the indicators that we have for impairment. Now, they come from 2 sources, internal and external. We'll first deal with the internal sources. The first of which is an evidence of obsolescence or physical damage. When we say obsolescence, it means there's a likelihood that the asset has outdated or there is a damage to the asset. So when that happens, we have to test whether the asset is impaired. It doesn't mean that when these things happen to the asset, it is automatically impaired. We're saying that when you see these indicators, it should prompt you to calculate the recoverable amount to ascertain whether there has been an impairment. Secondly, when there are significant changes to the asset use, now significant changes might include the assets becoming idle, plan to discontinue or restructure the operations to which the asset belongs, plan to dispose of the asset before previously expected date, reassessing the useful life of the asset from infinite to finite, poor performance of the asset. The third internal source will be the evidence that the asset's economic performance will be worse than expected. The fourth, operating losses or net cash flows for the asset, meaning when the asset is taken out is more than what it brings in. It can be a possible indicator of an impairment. Then lastly, loss of a key employee. If you lose a key employee, it means that the operations of the asset is going to come down. It can lead to the idleness of the asset. Let's move on to talk about the external sources. The first of which will be a significant decline in the asset's market value, more than expected by normal use or passage of time. Now, normally the market value of the asset is known. So you pick the cost of the asset, then you strike an accumulated depreciation from it. So ideally, you should expect what you have in your book to be what is on the market. But when there is a sharp decline in the market value of the asset or a cash generating unit, it is an indication that what the asset or the cash generating unit is becoming impaired. The second will be the changes in the entity's environment. When there's a technological change, we have to measure whether the asset can meet up to the change that has occurred. It can be in the market, the certain demands and supply, whether the asset can produce to meet what the market is looking for. It can be economic factors or the economic environment has changed. People's purchasing power has gone down, so they're not patronizing the services or the output of the product. And it also can be the legal environment. Certain laws has come into place whereby it might restrict operation of the assets. The next one will be the increase in the market interest rate. Now, this will affect the asset's value in use. As we said earlier, the value in use is the future economic benefit, which is discounted into today's terms. Now, when the interest rate goes high, it means that the value in use will be lower. So when the value in use is lower, there's a high likelihood that it will be lower than what the carrying value, which will lead to an impairment. And the last but not the least is when the net asset of the company is greater than the market value of the company. When your assessment of the value of the business is higher than what the market perceives it to be, then there should be an indication of an impairment. Now, when we take cognizance of the impairment indicators or the evidences, we would have to test the impairment. As I said earlier, you calculate the recoverable amount compared to the carrying value. So when you do so and the carrying value of the asset or the cash generating unit is higher than its recoverable amount, then there is indeed an impairment loss. Now, the impairment loss is the amount with which the carrying value exceeds the recoverable amount. Now, the carrying value must be reduced to the recoverable amount and the loss recognized in the financial statement. Now, let's look at how it is recognized. An impairment loss is recognized immediately in the profit or loss account or recognized in the comprehensive income if it is a revalued asset that has been decreased. Now, the carrying value of the asset or the cash generating unit is supposed to be reduced to its recoverable amount. Now, in the cash generating unit, the goodwill is first reduced. Then any specific asset mentioned to have been impaired is also reduced. Then the other assets in the cash generating unit is reduced pro rata. Now, the depreciation or amortization charge is adjusted in the future periods to allocate the asset's revised carrying amount over its remaining useful life. Now, an impairment loss for goodwill is never reversed. For other assets, when the circumstances that cause the impairment loss are favorably resolved, the impairment loss is reversed immediately in the profit or loss, or in the other comprehensive income if the asset was revalued. Okay. Now, on reversal, the asset carrying amount is increased, but it shouldn't be above the amount that it would have been without the prior impairment loss. Okay. So whenever you are reversing an impairment for any other asset apart from goodwill, it shouldn't exceed the original carrying amount. Depreciation or amortization is adjusted in the future periods. Let's test our understanding. A machine was acquired on 1st January 2015 at a cost of $100,000, and it has a useful economic life of 10 years. Now, at 31st December 2019, an impairment review was performed. Now, the fair value of the machine was $47,000, and the selling cost was $2,000. Now, the expected future cash flows are $10,000 per annum for the next 5 years. The current cost of capital is 10%. The annuity factor for this rate over this period is 3.791. We also prepared the extras from the financial statement for the year ended 31st December 2019. Let's look at the solution. Now we'll first calculate the carrying amount. The cost of the machinery was $100,000. Accumulated depreciation will be $50,000. That is the $100,000, which is the cost, divided by 10 years, its useful life, times 5, because we are calculating from 2015 to 2019, giving us 5 years. And the carrying value will now be $50,000. Let's move to the recoverable amount. We'll first have to calculate the fair value less cost to sell, which is $45,000. The $47,000 fair value less cost to sell of $2,000. Let's calculate the value in use. Now with the value in use, we'll pick the annual inflow and multiply by the annuity. This time around, the annuity has already been calculated for us. If not, we would have used the 10% and used some formula to bring us to the annuity period. So we just multiply the 10,000 by the annuity and give us 37,910. So now the recoverable amount should be the higher of the fair value less cost to sell and the value in use, which is the 45,000. Now we are supposed to compare the carrying value to the recoverable amount and determine whether there has been an impairment. So comparing 50,000 and 45,000, there has been indeed an impairment of $5,000. So record the depreciation for the year 2019, which is the 10,000. The 100,000 divided by the 10 years, giving us 10,000. Then we'll record the impairment. Now there was no mention of the assets being revalued, so we'll bring it in the profit or loss account. Now when we come to the statement of financial position, we bring the property, plant and equipment, where the machinery will be under, and record the recoverable amount, which is the 45,000 there. Simplicity. Let's test another understanding now on the cash generating unit. Now Peter owned 100% of the equity share capital of Sharon, a wholly owned subsidiary. Assets at the reporting date of Sharon were as follows. So we have goodwill of 2.4 million, buildings of 6 million, plant and equipment of 5.2 million, other intangibles of 2 million, receivables and cash of 1.4 million, all totaling to 17 million. Now on the reporting date, a fire within one of Sharon's buildings led to an impairment review being carried out. Now the recoverable amount of the business was determined to be $9.8 million. Sharon's business is now a cash generating unit. The individual asset of Sharon cannot produce cash flow on its own. The fire destroyed some plants and equipment with a carrying value of $1.2 million. And there was no option but to scrap it. Here you see that there has been a specific mention of an asset being impaired. Now the intangible consists of a license to operate Sharon's plant and equipment. Following the scrapping of some of the plants and equipment, a competitor offered to purchase the patent for $1.5 million. There has been another mention of a specific item being impaired. Okay, so take note. The receivable and cash are both stated at their realizable value and do not require impairment. So we are supposed to show how the impairment loss in Sharon is allocated among the assets. Let's take a look at the solution. The total impairment of the cash generating unit, which is Sharon, is 7.2 million. The 17 million, which is the total cost of the assets, less the recoverable amount of 9.8 million. Okay. Now we are supposed to allocate this impairment loss across the individual assets in the cash generating unit. Now, if we made the structure of disbursing the impairment loss to a cash generating unit, we'll first clear the goodwill. So the goodwill in the question was 2.4 million. We'll just clear it off. It will be left with an impairment balance of 4.8. Now, a specific property, plant and equipment, which was worth 1.2 million, was scrapped. It means that 1.2 million is the impairment loss. We deduct it from the balance, which will give us 3.6 million. Now, amongst the other intangible assets, a license which was used to operate the plant and equipment was offered to be purchased at $1.5 million. Now, the intangible asset is $2 million and is now being offered to be bought at $1.5 million. So the difference is $500,000. So we also come and less it from the balance, which will give us 3.1. Now, the receivables and cash are not impaired, so they are not supposed to be touched. 0. There is a balance of 3.1 million left, so we are not supposed to prorate it against the rest of the asset. The only asset left that was not specifically mentioned is the building, so we'll charge the whole 3.1 million to the building. So now when we come to the cash generating unit, the carrying value will now be, the goodwill will not come in because it has been totally scrapped. The property, plant and equipment will now have a carrying value of 4 million, 5.2 million original value, less the impairment of 1.2 million. The other intangible will also have 1.5 million, which is the 2 million less the impairment value of 0.5. Receivables and cash was not impaired as stated in the question, so we put the original figure, the 1.4 million. The buildings was impaired to the tune of 3.1 million, so we less it from its original cost, which is 6 million, giving us a carrying value of 2.9 million. So when we sum them, it will give us the 9.8 million, which was quoted in the question as the recoverable amount. So people, that is where we are going to bring our discussion to an end. If there's anything that you need us to address, kindly put them in the comment section below. It will be addressed in the shortest possible time. Whilst you do that, please click on the red subscribe button below and click on the notification bell by it. So we come away next time by way of tutorials on the go. We sign out. Stay blessed. Poker.